Thanks for joining us today on Market Call. I'm Morella Fernandez. Gordon Reid with us on the show. President and CEO, Goodreid Investment Counsel, taking your questions on U.S. equities. Here's how to reach us. 1-855-326-6266. You can email your questions as well. marketcall@bnnbloomberg.ca. Gordon, thanks for coming in.
You're welcome.
Let's talk about how you interpret what's going on in the markets right now, which is gaining equities, but also gaining oil. How are you looking at this? What does that tell you?
Well, I think it tells me that as we've often been taught, that event-driven market moves tend to resolve themselves fairly quickly. Market is forward-looking. What we've seen on the surface is not structural. It could morph into a structural issue if it goes on a long time, has an effect on economic growth, has an effect on inflation, but we're a long way from that. So markets forward-looking, expecting some type of resolution, and out of that comes a V bottom.
Tech has bounced back, of course, from concerns about overspend on AI. Why do you think investors are now embracing tech again?
Again, I think it's part of the digestion process. You know, we do have to process things. When you see companies spending, $150, $200 billion on something that doesn't have a guarantee of an adequate return, people get nervous. What we're now starting to see, interestingly, I think, is the beginnings of the effects of AI. Corporate profit margins are record levels. As a percentage of GDP, corporate profits is at a record level. We're seeing a new productivity spike beginning to happen. So the implementation of AI, I think, is just starting to take hold, and it's going to have an enormous effect on the ability of companies to generate profits, to be productive. Now, it's going to have some ancillary issues. They're not all going to be good, and we're going to have to deal with them. But on the surface, there's some good things happening. And as an investor, we want to defend against the bad and embrace the good.
We have earnings that are coming out. I'm wondering whether you think that earnings either now or in the next quarter will be affected by what's going on in the Middle East.
Some sectors of corporate America will be affected. I was just chatting this morning with a colleague, and we were commenting on the fact that this is an ideal time for corporations to take cover. So if they have any bad news or they're feeling a little skittish about the way their own operations are going, it's the perfect time to say, oh, it's the war, and it's not our fault. And we haven't seen a lot of that. What we've seen is a lot of beat and raise, which is, of course, what we all want as investors. So contrary to what we think might happen, companies are confident, and they're coming out with that confidence.
Let's take a quick break then. We'll get to the first phone calls and emails for Gordon Reid, Goodreid Investment Counsel. Again, he's taking your questions on U.S. equities. Here's how to reach us. Back in a moment. Welcome back, and thanks for joining us. We're going to start with an email from Richard. He says, does your guest see any positive prospects for Lululemon? Lululemon, of course, just announced their new CEO. This was yesterday, a previous Nike executive. Do you think that's a positive change for the company? Do you see, obviously, investors aren't loving it. They haven't embraced the stock today, but what do you think?
Well, they're not loving it, I think, because it's seen as a safe kind of bet. And this person's name is Heidi O'Neill. She's come from Nike. Nike in itself, while she was there, had some significant problems. That's not to say that she can't have a positive effect on Lululemon, but the street is voting today and saying no. There's definitely cultural issues at Lululemon. There's long-term management issues at Lululemon. Stock has gone from, $5 116, I think it is, to 145. So the market certainly is not reacting positively. Fashion is completely fickle. It's tough to get right at the best of times, let alone when you have cultural issues within your management team. So I think there are other places to look. In the Canadian space, we own Gildan, which is an interesting company, very well run, has just made a purchase of Hanes, which wasn't well run. And we think there's big opportunity there to stamp the Hanes brand with the Gildan management and take advantage of that. In the U.S., PVH, which is Calvin Klein and Tommy Hilfiger, also a very well managed company and very inexpensive on a valuation basis and growing very well. So those are two places you might look in lieu of Lululemon.
Let's get to our first phone call then. We have Chris on the line in Delta, BC. Chris, go ahead.
Oh, good morning, Morella and Gordon. Great to have you back on the show. I'd love to ask your opinion on Lennar, and I've been waiting to ask you on this one because I know you've been favorable on the name in the past and the home builders in general. And I've been buying the dip on Lennar and quite recently, actually. And as you know, with the recent little pop up in the markets, I'm now up about 10.5%. And I don't want to be a penny wise and a pound foolish, as they say. And you've said things like that, those adages in the past, and I don't want to get caught up in that. And if you still think it's a worthwhile investment at these levels for a long-term investment, then I would like to continue adding. So I'll hang up and listen. Thank you so much, as always.
Thank you for the question. So it was at 142 last year, end of August time now to 94, 97. What's been holding the stock back? And housing's difficult generally right now.
Well, housing is difficult, and there's been a couple of head fakes. Months ago, universally, people were expecting interest rates to fall. The telegraphing was there, the politics were there, everything was lined up, the economy was there, and of course, look where we are right now. Now, that doesn't mean that can't change, and I think longer term, we will see lower interest rates on the short term. On the long term, we'll have to see what happens there, but it's going to be somewhat positive for housing. Housing is, if there's any sector that's interest sensitive, it's housing. Lennar is a company that we did own, and we sold it when they did a reorg and they spun off their land holdings, and it was just a bit of a messy reorg, and we don't like to be in the middle of that, so we sold Lennar. We still continue to like the company. We like the space, and I think that this is one of those areas where you can pick and choose amongst the companies. We own, for example, Pulte, we own Atoll, and we own TriPoint, but I caution against TriPoint because it's involved in a takeover, so it's a bit of dead money right now because it's already bumped because of the takeover. But be in the space in proportion. And do your research on the individual companies. I've mentioned a couple that we own, and I would include Lennar in that, even though we don't own it. I think it's still a very, very good company.
Would you add to your position at this point?
I think it deserves a full position for the space, but of course you never get overly enthusiastic on any space, because the market, for anybody who's been in the market for a long period of time, will always make us look foolish if we become too greedy.
Let's get to the next caller then. Jim is in Elliott Lake, Ontario. Jim, go ahead.
Hi, good afternoon. Just your thoughts. I want to ask you about Johnson & Johnson, but maybe kind of around the same time, Procter & Gamble. I mean, both kind of steady eddies over the years, maybe Johnson & Johnson a little bit more. You take a look at P&G right now, their 1 year number, they're underwater here, a little over 12%. If you had to jump into any one of the two today, which one do you think would be the better buy?
Would you jump into either today?
We don't own either of them. Of the two, I think I'd move towards Johnson & Johnson, but I'd be hesitant to put them in the same basket. Johnson & Johnson, of course, a healthcare company, and with the spin-off of their consumer products area, they're much more of a pharmaceutical and a medical device company, but pharmaceuticals are sort of leading the way, and they're doing well, very well with the pharmaceuticals. Procter & Gamble, of course, is a consumer products company, and the consumer is in some
hurting.
difficulty.
Yes.
Sure, and the jury's out as to whether we've seen the worst of that dip. And again, we can come back to discussions of geopolitics to weigh in there. But of the two, I would gravitate towards J&J. I think it's a good buy. It's not overly expensive, so the valuation is not that demanding, and they're executing well.
Let's get to the next caller then. Faisal is on the line in Toronto. Faisal, go ahead.
Hi, good morning, Morella. Good morning, Gordon. Gordon,
Hi,
just on a side note, it's always a pleasure and privilege to have you on the show. Very calm, very measured voice. My question is on Merck. I believe on Monday they pulled the phase 3 trial of one of their drugs. Now, given that Merck has got a lot of drugs in the pipeline, the stock sold off. Would it be something that's attractive at this point? I'll hang up and get your thoughts. Thank you.
Thank you for the question. I wouldn't mind getting your thoughts on pharma right now, more generally.
Yeah. There's good opportunity in some areas of pharma. There are select few pure pharma plays that are constructive enough to command an interest. Merck, I would put in that category. A company like Pfizer, I would not. And the reason is, and Faisal mentioned this, is that they've got many drugs in the pipeline, dozens of phase 2 and phase 3 drugs in the pipeline, and they're necessary because the additive nature of the new drugs is compensating for the fact that many drugs that have been successful are going off patent. And in Merck's case, the biggest one is Keytruda, a very successful oncology drug, but over the next 4 or 5 years, you'll see a number of the patents on Keytruda go off, and that patent cliff will have an effect. But there's enough on the upfront side to compensate for it. I would probably say in the whole group, the biotech area offers more promise. In that area, we own Amgen, which we think has great promise. Again, like Merck, many drugs that are doing extremely well. In fact, some of the more mature drugs, they have 15 compounds that grew double digit last quarter in terms of year-over-year revenue growth. And that's the type of thing you look for in these companies.
Let's take a quick break on that note. We'll get back to your phone calls with Gordon Reid in just a moment. Stay tuned. Welcome back. John's on the line in Montreal. He's got a question today for Gordon. John, go ahead.
Hi, I want to ask Gordon about Bank of America. I'm retired. I have it in my cash account. Can Gordon give me an idea of what would happen to the stock price with the upcoming election, the midterms, if they go Democratic, and also with the new Fed, what he expects, and does he have a target price? Thank you.
Interesting perspective here, midterms, and then, of course, with the Fed change with Kevin Warsh. What do you think?
Well, the midterms, I don't think are going to have a huge effect on the money center banks, regardless of who holds the balance of power. It's not going to be so extreme as to change major policy. As far as the Fed, lower interest rates and a steeper yield curve are very constructive for the banks. And probably within the banks, there's no one better position than Bank of America to take advantage of that because they've got much greater exposure than the other banks to spreads. So their net interest income prospects are very good. So we like and own Bank of America, but we also own a number of the other money center banks and think that they're all positioned to do well. And making money off of loans and deposits is one side of banking, but of course these are big conglomerates that are involved in capital markets and foreign exchange and commodity trading and variety of other things, and they're all kind of hitting at the same time. They're all doing very well and have good prospects.
Pullback in March by about $4 or $5 for Bank of America. Was that private credit concern or something else?
There was some of that, but also the interest rate prospects of the likelihood of the Fed cutting multiple times kind of disappeared, and that hurt the banks. But you're right, private credit also hurt the bank. There really wasn't a big hit on the banks with private credit. It wasn't really a credit issue. It was more a liquidity issue, and it was a sales issue. The wrong people owned a lot of private credit. We often see this where private credit, for example, had a very good place in the credit dynamic. But individuals who didn't understand the liquidity, some of the gatekeeping that was going on, the ability to get out, that was the problem. So a lot of them were sold to the wrong groups.
Let's get to an email then from Grant. He says, what are Gordon Reid's updated thoughts on Alphabet? Google, of course, a lot of the tech gaining strength. Let's pull up that line chart and have a look where they stand today. Okay, so they're getting back to where they used to be, 339 today.
Yeah.
Are you invested in Google?
We are.
Yep.
We are, have been for many, many years, and it's done obviously very well for our clients. They're doing great. Last year, 18 months ago, people were saying, well, streaming and search is, rather search, not streaming, but search is going the way of the
dodo.
Dodo bird.
Yes, there you go.
Thank you, Morale. But that, of course, didn't happen. And those who have watched me know I've said many times that it's a bigger pie story. I've said that many times. And their share of search is going to fall. Of course, it was in the mid-90s. It's going to fall. But what's going to happen is that the pie will expand, so their total revenue base will grow. And that's exactly what's happened. And we're seeing the AI side attach itself to search. So Gemini is doing extremely well. It's got a leadership position in AI, large language models, and that continues. But of course, Alphabet is a much bigger company than just that. YouTube is the largest streaming service by a long shot. They've got about 23% total share.
And apparently people are moving away from sort of the longer Netflix because of subscription prices or ads maybe back to YouTube.
And attention span, which is maybe good, maybe bad. I would say probably bad, but that's a fact. Our attention spans are shorter, and YouTube is sort of built for that shorter clip. They have about a 23% share. Netflix, by comparison, is about half that, maybe 12%. And then you've got another one, maybe Disney, if you want to look at that, down in the lower single digits. So YouTube is a very big deal for Google. And finally, Waymo, which is self-driving cars. Of course, things that come from much different places, but all feed into this very powerful conglomerate.
Let's get to another caller then. John's on the line in Oshawa. John, go ahead.
Hi, thank you for taking my call, both of you. Good afternoon to you. Gordon, my question is on Apple.
Yes.
With the recent changes at the helm coming in September and the valuation currently, are you invested in it, and what is your opinion on Apple going forward? Thank you so very much.
Thank you for the question. Apple, of course, announcing a new CEO to take over, who was part of their hardware, leading their hardware division. What do you think of that hiring, or, moving over of the executive, and Apple's future here?
Yeah, he's going to have to prove himself. But Apple, if you go back to Steve Jobs, really they've had three leaders: Steve Jobs, Tim Cook, and now this new gentleman. In between, I guess, when Steve Jobs was in and out, they had some problems, but that goes back probably close to 30 years. We've owned Apple for 20 years continuously, and it's done extremely well for our clients. They've had ups and downs, but ultimately, this is a company that knows how to succeed. I think people are coming to appreciate their AI strategy, which isn't, the strategy really isn't new. It's one that they've employed on a number of different platforms. Let other people spend the money, get something up to the point of it being a commercially viable opportunity, and then stepping in with your vast resources and taking the helm. And I think that's probably what we're going to see with AI and Apple.
Let's take a quick break then, Gordon. We'll be back with more phone calls and emails for Gordon in just a moment, as well as a look at his past picks. That's next. Welcome back. Let's go through past picks from Gordon Reid. April 9th, 2025, so just over a year ago. At the time, he chose Freeport-McMoRan FCX in New York at $33.74 US. Now to $61.71, so 83% upside, 85% total return. This is a resource company, as we were talking about, with projects all over the world. Is it just sort of the popularity and the appreciation of metals in the last year that has led to their increase in stock price?
No, I would say it's a couple of things. One, though, is much longer term. It's secular growth of the copper market. So copper is being utilized more and more in today's society, electrification, the use of copper in automobiles, for example, or data centers. Has expanded dramatically. So demand for copper is rising at a much faster rate than GDP, for example. The current turmoil has also affected copper prices. So we've seen copper prices rise about $1 a pound in the last month. So they're over $6 a pound, and we think that gradually copper prices will rise, specific to Freeport, they have operations in Indonesia at a mine called Grasberg. And that mine had, unfortunately, an accident in September of last year. And it was a tragic accident. 7 miners were killed. It shut down the mine and production, of course. And today, you'd note that the stock is down quite considerably. They reported this morning. The report was constructive. It was good. But what they did say was that the Grasberg mine was not going to come back online as quickly as the market was anticipating. The market had thought that they were going to get back to about 85% production by the end of 2026. It looks like it's going to be about 65%, probably a bit of a one-day overreaction. But that also comes on the back of a stock that's been extremely strong. So there's a little bit of gap filling technically that I think has to happen. So this is probably a pretty good entry point for anybody who's watching this now. I'm not saying that it's necessarily over. We might, wallow around here in this area for a little while the gap fills. But I think longer term, it's a very good buy and will do well, for years to come.
Let's get to your second past pick then, which is Meta on the NASDAQ. Meta company we're all familiar with at the time. Last April, it was $585.77 US to $662.28 today, up 13% for return and total return. I'm just going to pull up the chart and see what it was like or when it took that spike, because it was lagging like a lot of them for a while.
Yeah. No, Meta is a company that's trading very inexpensively. It trades right around a market multiple, maybe a little bit light of a market multiple, yet its growth rate is considerable. Earlier in the show, Morella, I talked about the fact that investors were skittish about whether they were going to get a return on the vast amounts of CapEx that was going into AI. Last year, Meta invested $72 billion in CapEx, and they're projecting between 115 and 135 billion this year. It's a lot of money. Now, Meta can produce that types of cash flow, which is really a golden opportunity. But the market wants to make sure that it's not going to be wasted money and that it's going to have a good return. We believe that it will have a good return. And if you take that approach, you're going to do extremely well with this security. And the fact that it's trading at a very reasonable multiple, about 21 times earnings, creates a bit of a floor for the stock. It can absorb some disappointment if there is some along the way.
So end of March, it was down to 525. It looks like, so got a good bounce in the month of April. Let's get to your third pick. Morgan Stanley in New York. At the time when you chose it last April, it was 111.70 up to 189.47 today. 70% upside, 73% total return. And you're staying with Morgan Stanley, I imagine.
Yeah, absolutely. They reported last week, and of all of the big banks and investment houses, Morgan Stanley arguably had the best report. Their return on tangible common equity was 27%. I mean, this is astounding. This is just wonderful execution. And it's a company with $5 trillion of assets under administration. They own, of course, Smith Barney going way back, but more recently they purchased E-Trade and Eaton Vance. So that wealth management business doing really well. And they're well positioned in the capital markets area. We're going to see some just mammoth IPOs coming. SpaceX is coming around the bend, and the IPO is rumored to be in excess of $2 trillion. So these investment banks are going to do really, really well on capital markets business.
Let's take a quick break then. Gordon will be back with more phone calls and emails for Gordon Reid of Goodreid Investment Counsel. Back in a moment. Welcome back. Gulan's on the line with a question today in Toronto. Gulan, go ahead.
Oh, hi, good afternoon. My question was on U.S. banks in general. I had very little exposure, so I went and bought a Bank of Montreal ZWK, which is all U.S. banks. What's your general view on U.S. banks? Are they going to go up? And the second minor question is the status of the U.S. dollar versus Canadian.
Okay. Thank you for the question. I know you like U.S. banks. You think they will do well.
I do, but of course you have to rank them, which is kind of why I would probably not go with Gulan's strategy and just buy an ETF. There are haves and have-nots, and I'd say on the have side, I mentioned Bank of America and Morgan Stanley, but one we haven't talked about is Citigroup, and it's having a bit of a renaissance under Jane Curran, we very much like it because it's undervalued. Some of the others, the more senior ones, J.P. Morgan, for example, is a senior bank and is priced that way. But of course, in this kind of environment, you want to take advantage of companies that are up and coming, and I think Citigroup certainly fits that.
And you, as you said, you'd go straight into stock as opposed to doing an ETF for that.
I would, yeah. And on the negative side, I'd probably there aren't too many, but Wells Fargo is not our favorite. I think there's execution issues that should be avoided, and you can pick and choose. So Citigroup, Morgan Stanley would be probably at the top of our list. J.P. Morgan is also on there, and Bank of America certainly. Yeah.
Let's get to the next caller then. Amy is on the line. She is in Toronto as well. Amy, go ahead. Amy, are you there? Okay, we may have lost her. Let's go to Vahid in Victoria, BC. Vahid, go ahead.
Yes, I appreciate Gordon's opinion about Nike, and if he recommends this at this time or not. Thank you.
Thank you. Nike trying to do a turnaround.
Yeah.
Hasn't been that successful so far.
Right.
I don't know how long their CEO has been in. It's been a year or more, right?
I would say more.
Okay.
There's so many good choices out there that I think that taking the risk of going with a turnaround that hasn't demonstrated an ability to do it is, not something you want to do. So we would avoid Nike at this point. I talked about Lululemon earlier in the show, and there's some similarities. They have a little bit of a problem with the style, but they also have some execution problems and marketing problems geographically. Their China strategy is, up in the air.
Hurting them in the U.S., yes.
Yeah, so there's lots of choices here, Morella, and why take a big risk when there are some good companies that offer quality and good pricing.
That was Vahid. Let's move on to our next caller, then William's in London. William, go ahead.
Good afternoon. I'm thinking of selling my Telus stock to buy Boston Scientific. Do you have an opinion, please?
Thank you for the question. Go ahead, Gord.
Yeah, I wouldn't do it, William. At this point, Boston Scientific is a turnaround situation. It was amongst a group of healthcare companies that were growing very, very well, but were very, very dearly priced. And what has happened to a lot of them is that they're being re-rated because their organic growth is starting to slip. And we saw it with Boston Scientific's latest report just, yesterday, I believe it was. The stock has come off a long way. We liked this company and spent a lot of time looking at it over the last few years. And there was a lot of discussion in the office about it. And we had a very strong opinion coming from Julian Nonowamdam, who works with us and has been on this show a number of times, who knows the space very well. And he strongly came out against Boston Scientific, and he's been dead right. And we value him.
Okay, let's leave it there for now. We're going to take a quick break. Gordon Reid with us today to answer your questions on U.S. equities. Back in a moment. Welcome back. Gloria has been holding on the line in Toronto with a question. Gloria, go ahead.
Oh, hi. I would like your opinion, please, on Microsoft. I don't own this stock. Is it a good time now to buy for long-term investment? Thank you.
Thank you for the question. I know you've held some of the tech stocks. I'm just wondering where you would put new money today. Is there one over the others that you like more today?
That's a good question. We do own Microsoft, but we, as I've mentioned earlier in the show, own some of the others in terms of, so we own Alphabet, of course, and we own Meta, we own Apple. Microsoft is certainly a stable company within this space, so they're going to be a participant. They've got a fairly significant investment in OpenAI. They're a big cloud company with Azure, number 2 after AWS, Amazon, but ahead of Google in terms of market share. And their operating system will adapt to the AI world, I think, quite well. So we do like Microsoft. I'm reticent to rank them because things change so quickly.
I guess because the stock is down, she's looking at the drop and thinking, is now a good time to dip in?
Well, I would say yes, it is. It trades at a little bit more of a premium multiple than, for example, Meta, but you get perhaps a little bit more stability. Mark Zuckerberg is a little bit more of a cowboy than Mr. Nadella. So, there's pluses and minuses for all of them. But yes, I would put new money into Microsoft. I think it's good value. The difference here is that, and I mentioned this earlier, the money that's being invested is all free cash flow. So these are companies that are generating hundreds of billions of dollars of cash, and they're choosing to invest it in the next generation, being AI. Their pricing as stocks is still very reasonable. So in Meta's case, in Google's case, down in the low 20s, in Microsoft's case, maybe touching 30 times earnings. Not expensive in terms of historical comparisons. Go back to the late 1990s, and we saw the building of the internet bubble, and companies like this were trading at 60, 70, 80 times earnings. So there was no room for error. For that reason, I think that all of these companies represent good value. I would tend not to pick just one. I'd pick a basket of good companies, as we have, and let it work.
Let's get to the next phone call then. Raj on the line in Brampton, Ontario. Raj, go ahead.
Good afternoon. Thank you for taking up the call. I would like to know your opinion on Novo Nordisk for 1 to 2 years of investment.
Okay, thank you for the question. Novo, of course, benefited from the obesity drug craze, but I believe they're losing patent, aren't they?
Well, they're losing share.
Okay.
And that's the big deal, is that Lilly is really winning the race. And you can see it in Novo's price. It's just over the very long, or not the very long term, maybe a 3-year chart would show what's happened to them. And you can see that they've come down dramatically. And that's a share issue. And Lilly is winning the race. There's different applications. Right now, of course, the method of administration is by injection, which isn't the most marketable. A lot of people don't like that.
Want an injection, yes.
Aspect of it, but we're very close to an oral delivery system. It's coming very soon. And then, of course, what we'll get is the time lapse situation. So there'll come a time when we'll take one pill once a month, and that type of thing. So it's the whole space. GLP-1 technology has got a ton of legs, both from a diabetic treatment standpoint and from an obesity standpoint. But you have to pick your choice here, and it wouldn't be Novo for me.
Let's take a quick break then. We have new picks from Gordon when we come back. Stay tuned. Join us tomorrow on Market Call. Greg Newman with us on the show, Senior Wealth Advisor and Portfolio Manager at Newman Group, Scotia McLeod. He'll take your questions on North American equities. That's tomorrow. And if you miss Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Let's get to some new top picks from Gordon Reid. Gatex Score is the first one in New York. Tell me a little bit more about this company. I'm not familiar.
Well, it's a very old company, over 100 years old. It's in the rail car leasing business primarily. They do a little bit of aerospace, but primarily it's rail car leasing. What attracted us was that it's a very stable company. It's a quality company, but things have changed a little bit in the last few months. They did a transformational deal with Wells Fargo, and they bought their rail car leasing company, which effectively doubled the number of cars they have. So they picked up another 100,000 cars, so they're now over 200,000 rail cars. And it was a joint venture that they did with Brookfield Infrastructure Partners. It was a favorable deal from a financial standpoint with Brookfield taking on most of the debt. So it's really just a plain financial deal for Gatex. They traded about 18 times earnings. It's an area that is seeing a bottoming, so we're starting to see more trade, more movement of goods. So we expect that the space will grow probably around 5% annually through the mid-2030s, which of course is in excess of GDP and will give them a tailwind. So it's a very good company, say a quality company, ROE of about 12%. So we're pretty excited about owning it here.
Is any of your take tied to the negotiations for the trade deal that will determine how much more or less crosses the border?
Yes, and that is that things pass. So we tend to look at things over a longer period of time. President Trump is there now for another 2.5 years or so. But looking past that, we're probably going to see freer trade, more open trade, because things ebb and flow, and we're certainly kind of locked up right now. And while he has another couple of years or 2.5 years in the White House, markets are forward-looking. So they're going to start to anticipate things well in advance of any change in administration.
Let's get to your next pick then, which is General Motors, also dealing with tariff concerns, what happens with the trade deal. Why is General Motors on your list today?
Well, for a few reasons. One is they've executed incredibly well. Wasn't that long ago that they were in the crosshairs, and tariff talk and General Motors were in the same sentence very often. They're off the front page now, and that's a good thing. But they've executed well. Tariffs are still a headwind for General Motors, but they've reconstructed their business plan. They've moved somewhat away from the electric car.
I was going to say, but at a cost, right? They all had big costs dealing with that pivot.
Absolutely, they did. But they did it while maintaining good cash flow. We think they're going to make about $12 a share this year, which puts them at a very inexpensive 7 times earnings. Enterprise value to EBITDA is even lower than that. So they're an inexpensive opportunity to buy a well-run company. Mary Barra has done a fabulous job with this company. And they see a path, and they're executing on it, and the market's rewarding. Did
you think it was the right move to pivot away from EVs the way their counterparts have, given what's going on in the U.S.?
Yes. You have to listen to the customer. Just a quick story about my own experience. I was down in California, and I rented a car, and they gave me an EV, and I drove it. Got used to how it drove. That was okay. But then when I had to take it back, I stood in a parking lot for an hour charging it. And I thought, what am I doing? This is crazy. And that's what a lot of people in the space are saying. And what that translates to is that the EV technology of being able to put a car on the road that runs well and so on is ahead of the battery technology that people are rejecting. It will catch up, but it hasn't yet. And I'm quite willing to wait. But they've made the right move for the time being.
Let's get to your third pick then, which is McKesson in New York. What do you like about McKesson?
It's incredibly stable. When you look at what they do, they're the largest distributor of pharmaceuticals in the world, over 1 billion scripts a year. You can look at the aging demographics of the world population. So that's going to lead to more and more distribution of drugs and pharmaceuticals. And we talked about GLP-1 drugs earlier in the show, and that's a huge growth area for McKesson. It's predictable. We love that, trading at an undemanding multiple and a good quality company.
And they're pretty much the only player in that space?
Well, there are other players, but not as large, yes.
Okay. Yeah. Let's leave it there. I appreciate you coming in, Gordon. Good to see you.
Nice to see you, Morella.
We'll see you again soon. Let's do a quick market check before we end the day. Markets in the positive last I looked, but now things have changed. The S&P is down only 3 points, so not a big change there. The Dow Jones, a 65-point drop on the day, and the NASDAQ, a 78-point drop on the day. I would say investors are confused about what's going on in Iran and other things when that news and that headline keeps changing. Thanks for joining us today on Market Call. We will see you back here again tomorrow.